It's 9 p.m. on the 2nd of the month. You check your phone, and there it is. Your full salary just hit your bank account. You sink into your bed, finally breathing a sigh of relief. In that quiet moment before sleep, you feel like an adult. You put in the hard work, you earned this money, and for tonight, your financial future feels secure. Then, morning comes. You wake up, check your screen, and find a barrage of deduction alerts. Rent? Gone. Credit card bill? Gone. The zero-cost EMI for your laptop, the Buy Now, Pay Later tab from Amazon, and the personal loan for a recent wedding. Automatic withdrawals, firing one after the other. By the time you're out of bed, your massive paycheck has been reduced to pocket change. The month hasn't even started. You haven't bought a single meal, and the balance has vanished. You never sat across from a banker or waded through stacks of paperwork to get here. A single tap for some headphones or a quick swipe to cover a dinner bill replaces the traditional friction of borrowing, drawing you into a cycle of debt that feels as effortless as a social media like. This chart breaks down the distribution of outstanding personal loans in the national economy, and it reveals that an enormous 41% of this massive debt burden is carried squarely by Gen Z, a generation barely into their careers. This data model shows the minimum due trap. On a 100,000 rupee bill with 40% interest, paying only a tiny monthly slice extends repayment to 21 years. Over 2 decades, accumulated interest completely dwarfs the original amount spent. Financial institutions present minimum payments as a convenient flexibility for the borrower. In practice, this system functions as a mathematical engine designed to generate decades of profit from a single, stagnant debt. Credit cards are just the foundation. Buy now, pay later schemes and no-cost EMIs mask their true cost behind a facade of free money. Hidden processing fees and mandatory GST ensure that you are paying a premium for the convenience of delaying a payment. These services succeed because the interface mimics a standard digital wallet. Behind that seamless experience, every tap executes a legally binding, unsecured loan agreement with a non-banking financial corporation. This frictionless design has paved the way for instant loans that regularly exceed 36%. The ease of access creates a dangerous loop. When a borrower cannot make a payment on one app, they download a second app to borrow the difference, locking themselves into a rapid downward spiral of compounding defaults. Previous generations generally took on debt for assets that grew in value, like homes or education. Today, the borrowing landscape has shifted toward immediate, depreciating gratification. Young adults now finance an entire lifestyle purely for digital validation. Travel now, pay later loans fund photo shoots at the Eiffel Tower, prioritizing a few days of online status over years of financial stability. This trend culminates in the wedding industry, where couples spend 5 times the national per capita income on a 3-day event. They start their married lives with massive high-interest loans just to provide a spectacle for hundreds of strangers. Institutional lenders aggressively fuel this behavior. Their marketing departments weaponize the psychological narrative that a luxury lifestyle is an immediate right, rather than something to be built over time. It is a system that pays you a meager 5% interest to hold your savings, while charging you 20 or 40% to finance your social insecurities. While the apps feel casual and gamified, the record-keeping is incredibly rigid. Every missed payment, even a tiny late fee on a food delivery app, is permanently logged into central regulatory databases, like the one shown here. These micro-defaults eventually surface in the real world. A candidate can clear every round of an interview for a lucrative career path, only to have the offer rescinded because a routine background check flagged a forgotten default from years earlier. Reaching midlife and applying for a home loan brings a different consequence. Because of a damaged credit history from your 20s, a bank may refuse you their standard rate and assign a heavy penalty premium instead. This comparative chart illustrates the impact of a single percentage point penalty on a 20-year mortgage. Over the life of the loan, that slight difference in interest translates into an astronomical loss in total wealth. The ultimate defiance of this system comes from opting out of the gamified status race entirely. Choosing financial autonomy over a polished digital image breaks the cycle of high-interest dependence before it can set its permanent trap.